you have to max out that capacity.
Welcome to the Service to Syndication Podcast, where we interview the biggest and most successful real estate entrepreneurs, investors, capital raisers in the world who have worn the uniform of this great country, those who provide services to our men and women in uniform, and other service-oriented professionals to provide you with the tool sets, the mindsets, and the skill sets to help you conquer your dreams and goals in real estate and to use this wealth creation vehicle so you can live a more successful, happy, and fulfilled life of generosity and prosperity. If what you desire is time, lifestyle, and financial freedom, you've come to the right place. We will bring to you the best real estate entrepreneurs who will give you the insights, the knowledge, experience, skills, so you can go out and crush it in whatever real estate asset class you desire. So grab a pencil and paper, sit back, and enjoy the ride on the Service to Syndication Podcast.
Hello, my servicemen and women and other service providers. Welcome to another episode of the Service to Syndication Real Estate Podcast. I am your host, Cedric Marlow. I am a U.S. Navy vet. Here on the Service to Syndication Real Estate Podcast, we interview the most successful real estate entrepreneurs, capital raisers, and fund managers, where most have donned the uniforms of our great country. We aim to provide the tool sets, the mindset, and skill sets for you to achieve your personal and business goals while using real estate as a wealth creation vehicle to help you live a more successful, happy, and fun-filled life. I am super excited today because I have with me Mr. Justin Freishtat, who is a top-notch fund manager. But before I properly introduce our exciting guest to you, please, I want to ask a favor of you. If you get some type of insight, mindset shift, if you learn a new skill, new information, receive inspiration or motivation to go out and take some progress in your life, please share this episode with some of your friends. Send it to someone you know who might be or could be interested in real estate. Share it on your social media, post it on your wall, or share it in your story. Help us spread our message while you help others. And for all of you who share this episode, I want to say thank you. I know you're going to get a lot of value out of this interview, so like, subscribe, and leave a comment so you can get notified for future episodes. Again, everyone, I have with me Mr. Justin Freishtat. Justin spent the first decade of his professional career building Heartland Foods, which was acquired by a private equity firm in early 2022, after the company had generated $87 million in gross revenue. Now, Justin raises capital and manages investor relations as the capital advisor for healthcare integrated technologies and is managing partner of Kearns Capital and Pitch Equity Fund. Justin also helps individuals and businesses start and build their brands on social media, monetize, and drive revenue as Vice President of Sales at Kearns Marketing. As an investor and fund manager, Justin has a diversified portfolio with positions in multifamily and single-family projects, early and late stage pre-IPO private equity. All right, Justin. Hey, the first thing that I like to do with my guests is kind of have them to walk us through their career in 75 seconds or less, and then we can get into some deeper questions.
I like it. So we're just going to break this whole thing down, and maybe I can do it in like 30 seconds. We'll see.
That'll work.
Yeah. I mean, it started for me in college, trying to just figure out what I was going to do with my life, and it wasn't going to be found there. So 5 years into switching majors and feeling lost in life, I dropped out and started in door-to-door sales. And what made me do that was I was working in a warehouse packing orders for $7 an hour. And I saw the sales guys, and it was like, these guys make $100,000 a year. This is crazy. And just knowing that back then, this was probably 2010, 11, everybody was graduating making 30, 40 grand a year if they're lucky. So I decided to go that route. And 10 years later, I'd set every industry record. They all still stand for gross sales in a year, a month, all that stuff. And eventually moved on to building teams in that company, Heartland Foods. And at the end, we sold out to private equity. And it was very unexpected. Didn't see it coming. We just were in the right vehicle when the pandemic hit. The whole world wanted food delivery. It exploded, and we sold it at peak multiple. So that was a wonderful story. Tons of lessons there. and then moved on to what I was passionate about, what I wanted to be in, which was the private equity world, the investment world, the money world, where the margins are incredible and you can make a whole lot more money for your effort. That's the biggest lesson that came out of being in a tight margin business, a service-based business with tons of overhead, like a food delivery company, versus raising money, throwing it into real estate or private equity, all these different things. So that's what we're doing now. We're doing billion-dollar projects, and it's pretty crazy. I'm on the board of a publicly traded company, Safe Space, formerly known as Healthcare Integrated Technologies, and we're months away from applying to uplist on the New York Stock Exchange. So it's crazy how fast your life can change when you're really committed.
Yeah, 100%. I like it. I like it. So you helped build Heartland Foods from the ground up to 87 million in gross revenue. What were your key factors that contributed to that growth, and how did private equity acquisition come about?
Yeah, I mean, it was just a relentless pursuit of excellence. And in the beginning, I think everybody should learn how to build capacity. In that stage of life in my 20s, in early 30s, I wasn't in a work smart mode. It was just, how hard can I work? And I remember one year I literally said, I wonder what could be sold in a year if somebody worked every single day. So I was in someone's kitchen 365 days straight. And that's when I doubled the previous record for sales in a year. So that's kind of how that went. And then, you know, I'm a lead from the front type of guy. Like I want people to follow me and do better because of what they see, not because of what I say. So that's when I started building teams. I had to master it first. And it was really tough because in a food delivery company, we're a traditional door-to-door sale. It is not like roofing that has big margins, or home improvement or pools. So I couldn't pay the same commissions that these guys could make in these other industries. So it was a very difficult business to scale. So even at, my teams did 35 million in sales, but I carried most of the weight. I was always the top salesperson, even while building those teams and managing the whole sales and marketing side of the company. So you have layers to you and you build capacity. And then when I reached critical mass of how hard I could work, it was like, this vehicle is just not going to get me much further than where it is. If I had gone into solar, we could have gone to 100 million in 1 year based off of how great we were at business. We just didn't realize we were in a very tough vehicle. So when we had the opportunity to sell, which came out of nowhere, I mean, our sales tripled when the pandemic hit. We cut our marketing spend to zero. Our margins finally penciled to where private equity wanted to buy it. And when you have an opportunity like that, you have to say yes, which was a total identity crisis. I had done one thing since I was 22, and here I am at 35 years old, and we're exiting, and I got to figure out what I'm going to do with the rest of my life. So it was amazing, but it was also very, very mentally challenging to figure out the next thing.
I could imagine, especially when you've built your life on one thing, and then all of a sudden it's not necessarily taken away, but hey, you probably walked away with a nice chunk of change, but now you have to go back and figure out, okay, where am I? What am I going to do now?
Big time. You have all these thoughts, right? I think everybody thinks that their fears and imposter syndrome is unique to them. But I was asking myself questions like, can I do this again? Am I a one-trick pony? Like, was I just really good at this one thing? And maybe I'm just always going to be a direct sales guy. I didn't realize that I could even pivot and do other things. So I think the difference is that no matter how scared I am, no matter what the thoughts are intrusively in my mind, I still do it anyways and find myself in places that I didn't even dream of.
Okay. So now looking back at building Heartland Foods, what are some of the biggest lessons, both successes and failures, that shape your approach to business today?
Yeah. So the number one thing for me is now logistically, I think, if you're a Jeff Bezos or one of these crazy logistic minds, like, great. I hated it. Absolutely hated having trucks on the road, walk-in freezers, gigantic utility bills, just the gas and the tolls for the trucks and the salespeople. It was so much to manage. You can be doing 10 million in sales every year and barely making any money. So that was the biggest lesson to me, is the vehicle you choose is the most important thing. Choosing a tough vehicle like that in the beginning is probably a good thing, because it's going to build skills that you wouldn't be able to acquire without going through that difficult experience. But it leads you to a place mentally where you say, wow. And I'll give you a perfect example. When I started raising capital, I remember I had a Zoom meeting with a guy for 30 minutes. saw me on a podcast, and he wired $1.2 million into the fund, and it took me 30 minutes. At Heartland Foods, it would take me 6 months of knocking doors to do $1 million in sales. So it's like I figured out how to do the same revenue in 30 minutes that took 6 months before. So that's the lesson is wherever you are in the game, you have to max out that capacity and then don't get comfortable. The hardest thing to do when you get great at something is to say, okay, I got to go to zero and do this again in a vehicle that takes me to the next level. So that's the biggest thing that came out of it for me is instead of letting the marketplace force innovation on you, force it on yourself.
I love it. Love it. So what inspired the shift from running an operating company to managing investor relations, private equity, and hedge fund management?
The biggest thing I was looking for was great partners. I've always had partners. I've never done anything on my own. And in this season, I wanted to have nothing to do with operations. I want nothing to do with all of the parts of the business that I don't enjoy. So I said to myself, how can I bring my skill set, which is sales, marketing, the things that I like to do, talk to people, build relationships. How do I add that value to a group or a partner that's really excellent at all the stuff that I'm not good at and low logistics? I mean, what's better than raising money that has 100% margins and partnering with somebody who's great at due diligence, that's great at underwriting, that, knows how to do all the operations of, let's say, a real estate acquisition. I mean, of all the multifamily units we own, I've never been to a single one. And that's great for me. So I like to call myself a lazy workaholic. I'm trying to figure out now how to get the most output with minimal input. So the more juice and squeeze for your time and effort. And it's back to just the vehicle you choose is everything.
Lazy workaholic. That's a new one. I like it.
Yeah.
So for listeners unfamiliar with private equity and hedge funds, can you break down what Pitch Equity Fund and Kearns Capital focus on, and what type of assets or industries do they focus on?
Yeah, so they're very different. They're both 506Cs, which means we only take money from accredited investors. Kearns Capital does SPVs. They're called special purpose vehicles. Similar, we got different names for these in acronyms depending on the industry. If it's a real estate, they're going to call it a syndication. If it's late stage private equity, which is a fund we have at Kearns Capital, that's going to be called an SPV. So basically what we do is we raise capital for one deal, just kind of like a syndication, except it's going into a company. So when we think late stage, we're talking pre-IPO companies like SpaceX and Flexport. These are billion-dollar plus unicorn companies that all the big private equity is already in. So for instance, when we bought Flexport at $7 a share privately with a fund to fund relationship with Innovation X, and Andreessen Horowitz put in $1 billion into that company at $14. And then, we're buying it at half that price. So it's kind of like wholesaling houses. You make the money when you buy. We do that with private companies, and we'll either buy those shares off of early VCs that have already made thousands of percent because they were in ground level at 10, 20 cents, or there's funds that are in distress that need to liquidate for whatever reason. So we look for those opportunities there to grab private shares of great companies that will go public. I mean, previous exits at Innovation X, which is our fund to fund partner, they were pre-IPO on Palantir, Spotify, Lyft, Airbnb, and they sit on the cap table now at SpaceX to the tune of $500 million. So a little hedge fund like us, we might get a $3 million, $5 million allocation on one of those raises and then go fund to fund with them. So that's really an access play, because to get on the cap table of a company like that, you have to have a lot of cash and access. But if we create an SPV, we give access to the accredited investor for as little as 100,000 to get in a fund to fund to the cap table, one SPV removed. So that's our niche, is giving access to the small accredited investor to the best institutional opportunities out there. And then Pitch Equity is a customizable fund, which is very different. So the limited partner signs one generic PPM on the way into the fund. It's not deal specific. And then once they're in the fund, their cash sits there, and as we acquire deals, they pop up and they allocate their capital into the deal with just a simple deal disclosure. From a fund model perspective, every time you do a PPM for a new SPV or a new fund, you got to pay an attorney like 15 grand or something. So when you do a customizable, it's one PPM, you do it one time, and then it's deal disclosures into different real estate assets or businesses, or we have a debt fund that is a fixed return to the investors. It's kind of like a bond in a way. And then we have the discretion. It's a blind pool. So we raise the capital before we even know what we're going to buy. So that way we can close the fastest when we get the best opportunities. And that fund's going to own 80% real estate, 20% businesses. And that's how you still get that real estate exemption, but you can buy private equity as well.
Okay. All right. So what I'm hearing you say is you work really like with two companies, one that buys primarily, like you said, real estate and private companies. And then Kearns is more so on the private equity where you're investing into early stage IPOs and companies like that.
Yeah, it's a very different approach when you're investing in a late stage private equity like a SpaceX. You're in it to get in at a good private valuation for the IPO where you make all the money on the exit. Mm-hmm. Very different than what we do at pitch equity, where we're buying small, boring, cash flowing businesses that have 30 to 40%, 50% margins, a lot of e-com. We're looking at pharmacies, things like that, where, if we can spit off 40% cash flow and then pay our debt fund investors 16% on a monthly note, I mean, everybody's getting cash flow. We're making money on the spread, and, everybody wins.
So someone's listening to this, right? And they're going to ask this question, or it's going to be in the back of their mind. So I'll ask the question. How do you split the time in between the two? Because raising capital is raising capital regardless of which way you're doing it, but you're doing it for actually two firms versus, say, one.
Yeah, in a way, you need this amount of deal flow and options, because my capital raising approach is not, investor, nice to meet you, here's my deal. My approach is, hey, investor, what are you looking for? Are you looking to do a 5 to 10 year hold to get a higher equity multiple and you don't need the cash? Do you need income because you're heading into retirement? Like, what are you looking for? And then I have a suite of options to pair the investor with what's right for them. So that's why I need these options. And then if you think about the late stage private equity, we might only get 1, 2, 3 opportunities a year to raise for those. So I need a way to raise continuously. And I also want to have the big flagship once a year opportunities, like getting into SpaceX at a discount. That's not something you're going to be able to raise for every day. So, and then on top of it, we've got the marketing business that we're in all day long. So for me, it's easy to manage all this stuff because all I do is talk to people, do media, and raise money. So I live on Zoom or in person, and I'm a just execution based off my calendar. Like, if you don't send me a calendar invite, like, it's not happening. Right. But everything's scheduled in 15, 30-minute, hour increments, and, 12 hours of just pounding it every day. And like, it's a Saturday morning at 7 a.m. on the West Coast. And here we are, ripping a podcast. And I love this. So there's nothing else I'd rather be doing. And it's actually not that difficult for me to manage.
All right. Yeah, that's it. I'm like that too, pretty much. If it's not on my calendar, it doesn't exist. I live by that calendar. I mean, second thing I do in the morning, check that calendar to see what I have in store for that day, because I need to make sure that I'm going to be at the appointment at the appointed time. Because the worst thing for me is to have my phone out and then that calendar invite pops up. Hey, you got to meet with Justin in 15 minutes. I'm like, what? I don't remember that. But yeah, you definitely live and die by that calendar invite. Yeah, I understand. So, Justin, you're involved in, like I said, multifamily, single family, and pre-IPO equity. How do you evaluate risk and opportunity across these various different investment classes?
Yeah, so for me, I would kind of look at my due diligence as a limited partner. I don't do the underwriting, all the deep dive work. My partners are the experts in that, and then they'll bring us the deal. So a lot of it is trust. What I've learned. I mean, my partner at Pitch Equity, Scott Boroff, I mean, he did $1 billion on Wall Street as an investment banker before even going into the private sector. He's got over 20 exits since then. He's rang the bell on Wall Street from founder to, public a couple times, so he has strategic relationships at banks, and, he has access to deals that are just stupid good. Now I see the difference. When I was getting started and I was at Heartland Foods, I was investing as a limited partner in tons of people's syndications. And I would look at the due diligence. I'd look at the demographics and, all of these things and say, oh, I think it's a good deal. 8% pref, a lot of these deals would be like, yeah, well, the cash flow will be 4% out of the gate. And it's like, what I've realized now working with Scott and some of these bigger players, that have done billions. I mean, they're getting deals at 80% off. I mean, we just bought the Bend in Chattanooga at a $26 million valuation, and the CBRE appraisal for it comes in at 131 million. Like, that's a deal, right, that you don't see. So that makes life for me as the capital raiser. I've had deals that are average that nobody wants to put money in. So it's not a skill set thing. It's a deal thing. Like, when you have the best deal in the market, the money's going to find it.
I agree. I'm just totally blown away with that valuation and what you bought it for. Oh my goodness. Who wouldn't want to invest in that deal?
And you think about it for the limited partner, when I'm raising capital, it's just like, hey, if you had a $1.3 million house sitting on the corner and they're willing to sell it to you for $225,000, is that a good deal? That's all I have to say, because that's what it is. They put $225,000 in, they get 1% of the deal, and it's instantly worth $1.3 million in equity on day one.
There you go. That spoke for itself. So you didn't have to sell that one at all.
Nope.
Yeah. So in your role managing investor relations, what are the key components of building trust with investors?
Yeah, investor relations is an emotions thing. It's emotional management, which back in the Heartland Foods days, I didn't realize that I was training for this. Every problem that came into the company, every complaint landed on my desk. I was the guy that diffused every situation, dealt with the angriest customers. I have a lot of patience and empathy in diffusing things. So investor relations isn't much different, especially on the public side of the company. It's safe space. You know, when we have days, we're very volatile right now. There's tons of news coming out, and the stock's up a couple 100% in a few months. You know, nobody calls you on the days when the stock's up 20%. And then we have after a multi-100% run up, we have a day where the stock corrects 30%, and the emails and the calls are flooding in, and you have to talk people off the ledge and be very compliant about it, because when we're talking about the regulations, especially around a public company, I can't give any forward-looking guidance. I can't give any insider information, and investors, they are going to ask questions that I cannot answer. It's just the nature. They're going to say, well, what does revenue look like, coming out in the next quarter? It's like, you'll hear it when the quarterly earnings are filed. If I told you that right now we're insider trading. So it's a lot of management on myself, because of course I want to tell people good news. Of course I want to answer all their questions, but I have to manage their expectations and remind people on the private side, you're a limited partner. Sometimes these limited partners want to act like general partners. And that's a very fine line of getting them to respect the GP to make decisions. When you put your money into these funds as a limited partner, you are yielding control to that capital and saying, this person is better to manage it than I am, and you need to stay out of the way. And that's difficult for a lot of people because it's emotional. They're giving you their hard-earned money. So I empathize with that, but at the same time, you have to manage the expectations when you're dealing with investor relations.
Yeah, wholeheartedly. It's definitely emotional. And, I think what I've seen is for those investors that have a lot of money, we'll just say, to invest, it's one thing. But if I have 300,000 and I give you 100,000, now I'm really invested. I need that money to turn over, whatever the returns are, so I'm watching it like a hawk. But when you got a busy high net worth individual who has other assets and things like that, they're not as concerned as others, so, but yeah, you definitely have to temper their expectations along the way, 100%. Yeah, it's also, if someone is seasoned and they've been in the private placement world long enough, they've experienced losses. Yes.
Right. And I can say that for myself. I've lost some deals. I've lost a lot of money, and you can tell when someone's been through that before and if they haven't. And if you haven't been through that and you're new to the private placement world, in a weird way, like, I want it to happen to you so that you can become the person on the other side of that and that's been through it, because you're not going to win all the time, especially in investing.
We know you're going to like this episode, so please like, comment, and subscribe to this channel so you can be notified when the next episode drops.
Yep. So true. So raising capital can feel intimidating for many entrepreneurs. What are the biggest mistakes you see when people try to raise capital, and how should they correct it?
You got to have a great deal, number one. If you're going out into the marketplace and you want to raise capital, like, you need to know your deal inside and out. You need to be a subject matter expert on what you're presenting. This is the hardest sale in the world, is to get somebody else to say, my money is better in your hands than my own. That's what you're doing. So I think how you do anything is how you do everything. I think the way you dress, the way you take care of yourself, your health, like, these are things, the second someone meets you, whether it's online or in person, they're making a huge judgment on who they're dealing with. So work on your communication skills, do a lot of podcasts, do a lot of media, speak on stages, even if you don't want to, because it's going to make you so much better at presenting your offer. You have to be able to do that with authority and confidence, but there's no substitute for being a subject matter expert on what you're presenting. And if you're not, it's not time to go raise yet. Like, really drill down and know your stuff.
Yeah, agreed. So then what trends are you seeing in private capital markets right now, whether in real estate, startups, or alternative investments?
It's a very interesting time. There's a lot of fear out there in the big money. I mean, we're seeing record amounts of capital sitting in blind pool funds that haven't been deployed on the venture side and in real estate. Everybody's waiting for this gigantic real estate crash. I think there's, $1 trillion of commercial debt that's coming due. It's going to shake things up. So I think everybody's waiting to see what happens with interest rates. It's also, on the private equity side, if we can borrow capital at 6% versus 8%, that completely changes, cap rates and underwriting and where the opportunities are. But what I've also learned is while all this money sitting on the sideline waiting for the market to shift, there's always a great deal to buy at any time. So instead of waiting for the next opportunity, you just got to work harder to find the opportunity that exists right now.
So Justin, you've mastered sales and scaled organizations. What does modern sales playbook look like today versus, say, 10 years ago?
Yeah, it's massively different. 10 years ago, I think there was still a lot of tactics and training and, how you ask your questions and, soft tie downs at the beginning, hard tie downs at the end. I've learned it all and I've rejected it all. I don't use any of it. What sales is in today's world, everybody has access to an unlimited amounts of information. People who are motivated to make a decision have probably already done their research. They're just going to decide, who do I feel the most comfortable making this decision with? So the frequency of authenticity is the most powerful sales tool there is. Show up 100% authentically, who you are, with great intentions, and be intuitive to what are the concerns this person's going to have and get ahead of them, bring them up on your own terms. Don't hide from any of it. That's what the amateur rookie sales guy does, is he just hopes that, the difficult things don't come up. And it's the opposite. I'm going to tell you all of the good, all of the bad, before you even have a chance to ask me anything, so that I'm putting it all out on the table. And that's how trust is built. People are okay hearing difficult things. They don't want you to hide difficult things from them.
Yeah, so true. So true. As vice president of sales and marketing at Kearns Marketing, you help people monetize social media. What are the first steps someone who's looking to build a personal or business brand should do?
Yeah, this has been everything for me. I mean, the first $10 million I raised in capital came straight from social media. And building your personal brand is the new business card. If you're going to be an entrepreneur of any kind, the biggest mistake you can do is build a business brand and hide behind that, because people don't follow businesses. They follow the person behind the business. If you look at the biggest influencers on social media in the business world, let's take a Grant Cardone, go look at all of his Instagram pages for all the companies they have. And it has like 1/100th of the following of the guy who's owning and managing the personality behind those businesses. So you are the business. Don't get it twisted. And unless you're building a massive billion-dollar brand like Coca-Cola, like, you're the brand. So that's the first thing you have to internalize. And when people go to search, it's little things. Like when we design brands on Instagram, we've done over 5,000 of these. So we know exactly how to do it and what works. Like your handle, like if you've got a company, your handle should be the company name and then your personal name in the name. So that way, whenever somebody's searching for you or your company, the same account pops up. Not that you shouldn't have a separate business page. That's fine to have, but you focus on the personal brand and then just collaborate the content with the business page. So you have to focus on the personal brand. And the other thing that I'll say about social media is this is what all the solopreneurs and business owners do. They go and just pound content and then their pages don't grow. No one's following them. And it's because social media is the most competitive sport in the world. The highest paid creators are making more money than professional athletes. So us business people have to get honest with ourselves. We are not full-time content creators. And even if we wanted to be, the odds of us being at the top of the food chain are virtually zero. So I'm one of those people that I just play it how it lies. I don't get delusional about things. And I know that entrepreneurial content is not funny cat video content. So the percentage of the algorithm that's interested in what we're talking about here is very small. So I'm going to have to use other tactics and vehicles to distribute my content. I'm going to have to leverage influencers and celebrities and all these things that we do to build brands, because just putting out your content alone doesn't work anymore.
Okay. I'm pretty sure a lot of people will get a lot of the great information on that. I mean, heck, I took away some things from that, with just building my own personal brand as well as my business brand. So you just mentioned Instagram. So what platforms or content strategies are working best right now for people who want to leverage social media?
So I specialize in Instagram. That's where I focus. Not that I don't have the other platforms. I think it's most important for you to figure out which one do you like the most. Do I want long form content on YouTube? Do I want shorts on YouTube? Do I want reels? Do I want TikTok? There's never too much, right? You do it all, but I like to focus on Instagram because that's where I have a competitive advantage, meaning that we have relationships with celebrities that we can do giveaway campaigns. We just did one with Floyd Mayweather. We've done Khloe Kardashian, Cardi B, and she puts up a post with a bunch of Louis Vuitton bags saying, hey, one of my followers is going to win all this. All you have to do to enter to win is follow this list of accounts, and I can get your name and your account in that giveaway. Overnight, you can get 30, 40, 50,000 followers from a celebrity's brand. They're all real people. Now, are they following you because they want to buy something from you? Absolutely not. But that's not the point. You have to build a brand with credibility first. I'm not trying to sell anything to my followers. This is a huge misconception. I'm trying to build a brand with credibility so that I can go into the direct messages and do campaigns that reach out to my exact target and pull them into an established brand, because people are going to judge the vanity metrics. They just are. They're going to land on your page. If you got less than 10,000 followers, we've done the direct messaging and we have the data on this, the conversion rates are virtually zero. If you have 100,000 followers, same page, same content, same messaging, converts at a much higher rate. So again, these people that are like, well, I'm going to do it the 100% organic route, pounding the table, like, you're just going to lose to someone like me that leverages all these other systems and opportunities out there.
Oh, man. Yeah, I can attest to this, Justin. Like, it is a grind, for building that brand through social media. And I understand how these content creators, that's all they do. I can understand how they're getting the followers they're doing and grossing the type of income they're doing, because they are pounding content every day, many hours of the day. And for a person like myself and other investors who may focus more on the business, it's so much harder to do. I guess you have to have some type of marketing team and company behind you.
Yep. And that's exactly what we do. I mean, my partners at Kearns Marketing, I hired them first to build my brand and then eventually joined the company. Like that's how this went down. And we started, I just wanted to help other people do it because it made so much sense to me. And if I'm great at something and I know how to help somebody do it, like I'm going to be all in on it. And that's where I am, because people this is the biggest thing. When you're creating content and you're putting it out on the platform, there's billions of people on the platform. That's like standing on the side of the road with a sign that says what you do or the message you want to get out. Right. Thousands and thousands of cars are driving by. Nobody's stopping to do business with you. But if I go and prospect and talk to 20 people in a day that are in the market for my thing, and then they're doing research on me and they're looking at the content, that's how you convert. So just in the marketing business, we do over 100,000 a month organically with no ads, straight from Instagram in DMs. That's how we do it. We don't use any AI. We don't use ManyChat. We don't use any of these integrations because everybody has totally forgot what social media is about. It's about authentically talking to people, right? So if you're just creating content, but you're not actively using your direct messages to talk to human beings, you miss the entire point of the platform.
Got it. Noted, as they say. Justin, for entrepreneurs listening, how can they align their marketing strategy with their capital raising goals?
I would say the biggest transformation that helped me with capital raising is understanding leverage of brand. So I could send direct messages to accredited investors whatever those avatars are, doctors, lawyers, people who make a lot of money, but it's not their thing. That's who's likely to hand over their capital, right? That's not the approach. I decided I was going to build a big brand that other people with bigger brands would want to leverage or bring me on their shows. And we did direct message campaigns to all of the biggest podcasts in the space. So we're talking, I didn't care if it was life insurance, if it was crypto, wherever wealthy people were listening, I wanted to be in that platform in long form and in collaborate the short. So it's going out to all these different audiences and you're leveraging other people's stages virtually. And then what happens is now you're networking with all the biggest players in the space. You do the show and then it's, well, what else do you do? Do you have in-person events? Can I speak there? Would you like to have me here? Now you're collaborating. And that's how I raised the first 10 million. The first year doing it from scratch, had no idea what I was doing. I just knew I needed to have as many people see my face and get to know me in long form. And the leads just come inbound to your Instagram after that. And now you flip the script on lead generation, which is, that's the beautiful thing about sales. If you have to cold call and pound, it's not fun. If you can flip the lead generation script where the people are inbounding you, then sales is fun.
Okay. All right. So leading sales teams and organizations is a different skill than selling, right? So what's your philosophy on leadership and performance management?
KPIs are everything with this. I used to, in the beginning, think that management was telling people what to do, being hard on them, all these different things. And it's really just setting expectations that are mutually agreed on and then managing to those expectations. It's very simple. It's how many calls are you going to make today? And you have to have an accountability system, right? Like if you don't have a CRM that tracks it, people are just inherently not going to keep themselves accountable. And then you're going to be angry and you're going to try to keep them accountable. You need systems to keep people accountable, right? So if you got people dialing and you got to make 100 calls a day, let's say in a call center, like whatever it is, but they don't make those dials from the CRM, you're doing them a disservice because their accountability is going to be in the fact that they know that we're going to see the data that will make them do the work. All entrepreneurs, like we're different, right? People that are going to work for you are not the same as you. So you really need to take accountability on that and say, how do I give this person a system where they can perform and be accountable to the system?
I like that. Yeah. Because as an entrepreneur, like we are wired different than a worker, right? That's just how it is. We can never settle. We're always thinking, we're always running. So I like the fact that you said, they're different than us and find a way for them to flourish in the business, in their job that they're doing. You guys come to an agreed upon KPI and stick to it and make it work. So Justin, how do you cultivate a high performance mindset, both for yourself and your teams?
I think in the beginning, everything is built. There's just no way around it. So, for a long time in the early days, I felt weak. I felt, and I was, right? I didn't have any skills yet, So I had a chip on my shoulder that I relentlessly despised my lack of skills, right? I was angry at myself about it. So I'm pounding books, I'm pounding podcasts, trying to get better. I'm role playing in the mirror. I'm disgusted with myself. Like it's like I'm being serious. Like I really was like you're disgusting. Like you need to build some skills. Like you can't even go knock on somebody's door right now. You're so mentally weak. You're scared to knock on a door, So you got to look internally and I think get a chip on your shoulder that makes you go out and become the person that you want to be. And that's done daily. So I actually learned to kind of, not that goals are a bad thing. I think goals are great, but it's going to set you up to be miserable on the way to the goal, hit it and then crash and need a new one. And you miss the entire journey. So now my entire thought process is the next 24 hours. That way I can live in the process. I can enjoy today. I don't like to use the word happy because happy doesn't exist in psychology. It's a fallacy. We're all chasing something that doesn't exist. It's a made up word. Your central nervous system just wants to be in homeostasis. So we should just be going for contentment. Like if you're really happy, that means you're going to be really sad and you're on these swings, and that's just your parasympathetic and sympathetic nervous system being out of alignment, right? So I think all the books I've read about that, trying to understand how my brain works, have developed into kind of an out-of-body experience when you look at everybody else who's living in their amygdala and they have no control over their thoughts, feelings, what they say. Learning how to live in your prefrontal cortex is a major skill set.
Okay. So then what advice would you give someone looking to transition from being, say, a solopreneur to scaling a larger operation?
Partners with experience and eat some humble pie. I think a lot of entrepreneurs just, they think they can do everything better than everyone and they get a little bit of ego going. I mean, I have zero ego. Like I think that's one of my biggest competitive advantages is that I just want to win. And I realize that the faster I win is by getting people who have already done the thing around me. Like I've learned more about public markets. I joined Safe Space January 1st of this year. So we're 6 months into it, my first publicly traded company that I've been involved in. And just being around Scott Boroff, I've learned more in this 6 months than a decade of reading books about, going public and how the whole thing works. So you've got to get around people who are way further along in the journey than you.
Yeah. I second that. And humble pie doesn't taste good sometimes, but you got to eat it.
Yeah. It's like, do you want your name on the door and be struggling, or do you want to be the third or fourth employee at Facebook who makes, hundreds of millions of dollars?
Absolutely. We'll take that second one all day long. But wow, Justin, looking down at the time, man, time has flown. You just been dropping nothing but great gems for my listeners. But before we finish this up, I have a few last questions. So across your career, from entrepreneur to investor, what's been the most fulfilling part of your journey?
Ooh, that's a tough one. And the most fulfilling part of it, I would say, is that everything that I've done at Heartland Foods was a health mission. We were, I've helped people lose hundreds of pounds, getting, educating them on how to eat, what's actually in their house, getting it out of the pantry so their kids are not eating terrible things. Making the world a healthier place was the mission. And, I felt great about that. We did meal matches with Feeding America. We fed hundreds of thousands of people. That is so rewarding. And then now with Safe Space, we've got a mission to save lives. Our AI technology is going to end school shootings. I mean, when you think about impact, being involved with a mission that changes the world, but also makes you wealthy at the same time is the dream.
Man, I mean, that would be so great to end school shootings. Oh my gosh. I mean, because that's one of the most horrible things that you can hear when, you hear it on the news or whatever. It's a terrible epidemic that we have here in America with that. But, so good luck with that. I mean, really, that's really needed in this world. So what role does mindset, discipline, and personal development play in your success?
It's everything. It's absolutely everything. The discipline is going to be built first. I can't remember what the stat is, but it's like there's less than 1% of people that are millionaires and have six-pack abs, right? So I look at these areas of excellence, and I think the first thing you do is pick one, get excellent at that, get into the 1% on one thing, because now you know the skill sets that'll do it in anything. And then you just start to do that in all the different verticals in your life. So to get 1% at anything is going to take incredible amounts of discipline, right? It's like the 7-day week. Most people think that they should go on vacation every week. It's like, if you take Saturdays and Sundays off, there's no chance you even get into the top 20%. So it's like that 80-20 Pareto principle. I need to get in the top 20. And then from there, I need to get in the top 20 of that, which is the 4. And then I keep getting 20% better until you're the less than 1%. And the way you look at statistics, to me, is the most important thing, because your brain will convince you of whatever you want to convince it of. So I always get the stat wrong. I don't care. I'm just going to use it for an example, just because 27.7% of stats are made up anyways, because I made that one up. But there's something like 75,000 households in the US that have a $25 million net worth or more. If by percentage, it's 0.0001%. Most people look at that stat and say, well, that's not for me. It's never going to happen for me. It's so low odds. And they convince themselves of why they can't. I look at that and say, wait a minute, 75,000 people figured this out. I can be the next one. So you have to believe you're the exception to the rule, or you'll never have the sustainability and perseverance to fight through all the moments you're going to go through when nothing's working, where you want to quit. And that's the difference. You got to build the stamina to never put an expiration date on the outcome and just keep going until it happens.
Yeah. I can't tell you how many times I talk to people and it's like, it's negative talk. And I have to tell them, I literally will correct them. I just did it last night with someone. And I'm like, no, you should be asking yourself, how can you do that? Not knocking the people that have done it. I'm just wired a little different, and I don't mind telling a person, those things. I try to correct them because maybe I can spark something in their mind to change their mindset and their mentality. So now, Justin, what legacy are you working to build personally and professionally?
I've thought about legacy a lot, and it's a slippery slope. I'm starting to think a little bit differently in terms of maybe, having a family, things like that, kids that pass on the next generation. But other than that, I don't believe in legacy. I think it's a complete ego thing. Like to want to live beyond the grave, have your name on a building. Like if these are your goals in life, I think you've got it twisted and you're going to miss the whole point, which is to enjoy your time here. Mm-hmm. So legacy for me is a daily thing. If I wake up and I get to have another day, like that's a beautiful thing. And if you have that mindset, I think maybe you end up creating something that you're remembered for, but to have a mission of legacy, to pass on $1 billion to your family or to have your name on a building, I think is just straight ego.
All right. Wow. Well, Justin, it has been a blast having you as our guest today. As we close out, please tell our listeners where we can learn more about you, get in touch with you, and learn about all the fabulous things you have going on right now.
Instagram's the best place to get a hold of me, but I'm on all the social platforms. It's at Justin Freishtat. It's a really tough last name, so there's only one of me when you search it, but it's Freishtat.
Love it. Love it. All right, Justin, again, I want to thank you for your time today and all the wisdom you have provided to my listeners. And I want to thank you, our fans, for tuning into the Syndication Real Estate Podcast, where we want to add value to you in your investing business. Please tune in to our next episode where we will interview another fantastic investing professional. See you next time.
Thanks for listening to the Service to Syndication Podcast. We want you to know that we love and appreciate your support, and we are grateful about being a part of your journey to becoming a successful real estate entrepreneur. Please share this episode with a friend who you think will get a lot out of what you just heard. Send it to someone who you know is interested in real estate and dreams of having it all and being the best they can be in all areas of life. And if this was really valuable, share it on your social media stories and timelines. Thank you for watching and listening. Now go be great.